Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking time out of your busy day to spend it with us. Wow, I think it's an unbelievable time to have a show like ours at this point, with the markets being as volatile as they have. I've been getting a ton of questions from individual investors about the markets. Are the markets, is this something the market's gonna, I guess, unfold into something greater? Are we gonna see a greater pullback for the markets? Or is this a minor blip? And are the markets going to, buy back in? Are investors going to buy back into the markets so that we could see another run up in some of these depressed names? A lot of individual investors just don't know what to do. They're thinking about, should I buy on the dip, or is this the start of something bigger? And so having a show like ours at a time when a lot of questions are out there, I think is just incredible. And these are the topics that we have for all of you today. Right off the bat, we're going to talk about understanding the recent market decline. What caused the market decline? There's a lot of, in my opinion, false reasons out there that are floating around. So we're going to talk about what actually caused the decline in the markets, and what do I see going forward? Is the Fed too late in cutting interest rates? We've been talking about this for quite some time. The Fed has not decided if or when they will cut interest rates. It's just a matter of time. I think all of us believe that. But will they cut rates as soon as September, or will they push it off further? Latest talk is that they will cut in September. We're going to talk about that as well. Bank of Canada, their tone is a lot more dovish. What we mean by dovish is a lot more towards the interest rate cutting side of things versus standing pat. As we know, the Bank of Canada has already cut interest rates twice. Will they cut a third time in September? We're going to speak about what the Bank of Canada is thinking, and I guess give a glimpse into what we believe the Bank of Canada will do. As always, top 3 things to consider over the next couple of weeks before you make your investment decisions. This is the part of the show where I talk about 3 things that I think are important for individual investors to consider. Mag 7 or the other S&P stocks, other 493 stocks. And as you know, the Mag 7, the biggest tech names in the world pretty much today, biggest tech names in the United States, obviously carrying the load for the market. Main reason why the market has had the performance that it's had, the S&P 500. Should we be looking to buy these names, continue to buy them on the dips, or look at the other 493 stocks on the S&P 500? And second last, we're going to have quick hits. Part of the show that we introduced a few shows ago, where we talk about 3 things that I think many of you have seen in the news recently. Talk about why they're happening and speak about those things, and maybe answer some questions on these 3 quick hits, these 3 things in the news today. And finally, your questions. As always, I want to take as many questions as we have. We usually have time for 1 or 2 questions. If you have any questions during the show, please put them in the comment boxes. And I'd be happy to get to them at the end of the show if we have time. If we don't, we'll get to them before the next show, or we'll answer them during our next show. So without further ado, let's get on with the show. Understanding the recent market decline, I think, is really, really important, because many people, I guess, over the last week or so, they came to me and said, Allan, you know what? I'm really fearful. I'm actually thinking about selling out my investments. The world is in turmoil right now, and it's really spooking me. And perhaps it's time to sell. And I had this conversation with a couple individuals recently, and I said to them that I don't think it's about the world being in a bit of turmoil right now. I don't think the recent decline in the stock market has anything to do with geopolitical events, what's going on in the Middle East, or what's going on in Russia, Ukraine, or with China, or the US election. Really, what spooked the markets, I guess, last Friday, if we go back to last Friday, is this jobs data or jobs report out of the US. We were expecting about 185,000 jobs created in the US. We ended up getting a much lower number. The United States created about 114,000 jobs. Not only that, they revised downward the previous month. So the month of June, down to below 200,000, down to about 179,000. And this really spooked the markets for some reason. Prior to that, whatever data came out, the market seemed to look past it. But this data in particular, I think, gave individual investors a reason to sell. It gave the computer programs a reason to sell. And that's what we saw last Friday, on Monday, while we were closed here in the Toronto Exchange in Canada. The US was open, and boy, were the markets in tough. The Dow Jones down over 1,000 points. Markets were down 3%, pretty much right across the board. Dow Jones maybe 2.5%. NASDAQ down well over 3%. S&P 500 down 2-3% as well. So this is what happened. It was all about this idea that, well, maybe things aren't as good as the Fed thinks they are, and perhaps the Fed should have already cut rates. The talk was so fearful that I heard some people saying maybe they should have an emergency cut. They should cut rates before their next meeting. They shouldn't wait to their next meeting. I even heard someone say they should cut 75 points as an emergency cut before the September meeting. So to me, this is just fearful talk. We really didn't see that bad data. We still saw jobs growth in the US. 115,000 jobs were created. It wasn't like we saw negative jobs growth. So I just don't understand why we went from a situation where we're still fighting inflation, that inflation is the number one issue and the number one problem that as investors, as an economy, the US has to fight, to fearing a recession, fearing a huge downturn in the market, one that we would have to see a big cut, and perhaps even an unexpected cut nonetheless. So to me, I think the drop in markets was overdone, of course, to the downside. I don't believe the U.S. economy is in as bad shape as we've seen over the last year or so, last few years. Yes, the U.S. economy is slowing down, but is definitely not in anywhere near a recession. First chart we have for you today is one that really shows us the S&P 500. S&P 500, I believe it's a monthly chart. We can show it here. There it is. And you can see really how big and how steep the decline has been. And not only has it just been earlier this week and end of last week, but the S&P 500 has been falling for, I guess, a few weeks now on the back of this idea that maybe things are slowing quicker than the Fed really believes. Second chart we have for you here is the NASDAQ. Again, a 1-month chart, and you could see that the fall in the markets is definitely based on, or at least led by, the tech stocks. Obviously, the tech stocks make up most of the NASDAQ. There are a lot of other stocks that are trading there as well, but the tech stocks make up most of the NASDAQ, and you can see how much the NASDAQ has fallen. It actually got into what we call correction territory, meaning down by more than 10% from the high. But what I tell clients when they ask me, how bad is it? Should I be concerned? Should I be worried? How much have I lost? I think the next couple of charts really show this. Let's show the S&P 500 on a 1-year basis. And what I want to tell all of you watching today is, think about it. The amount of loss that perhaps individual investors, perhaps all of you have faced or have experienced in the last couple of weeks, that wasn't really loss. When you look and see how much your portfolios or how much the stock market has gone up in the last year and a half, you've given back some of the gains. That's really all you've done. On the S&P 500, you can see here, the market, the S&P has come down, the chart has come down, but nowhere near where it was a year or two ago. If we take a look at the NASDAQ, let's put that 1-year chart up, you'll see the same thing. We've just given back some of the gains. And as we now know, of course, Tuesday was a great day. We made back a big chunk of what we lost on Monday. So everybody, or at least many investors, were saying, let's buy that dip, let's get back in, because investments have gotten way too cheap, way too oversold. And to me, that made sense. And I was a buyer at that point as well, buying for individual investors of mine. And it just made sense that overall, this market wouldn't stay down for too long. And not to say that everything's going to come right back up. Obviously, we might see the markets kind of go sideways for a little while. But overall, I still maintain that we will be higher at the end of the year than we are today, even with the recent decline that we've just noticed. The next chart that we have here just shows you how fearful people were. The VIX here, the volatility index, you can see here, the volatility index is an index that shows basically it measures fear in the markets. You can see spikes that have come on during COVID, during the financial crisis. And you can see that the recent spike in the VIX, we haven't seen a time like this since the pandemic. We actually saw the VIX reach 65. Just a week ago, or maybe a week and a half ago, it was like 15. All of a sudden, everyone becomes fearful, the market sells off, and the VIX spikes well beyond where it should have. And in my opinion, I think this just goes to show you that how much fear there was in the market. And usually when we see the VIX spike like this, it's a contrary indicator. When we see a spike in the fear and the volatility, that usually is a time to buy. And those that buy at that time usually do well in the coming months and quarters and even years to come. So keep that in mind as, I guess, a contrarian index or a contrarian gauge as to how the markets are doing. So for me, looking back, I think that the markets, yes, they dipped. They dipped unexpectedly. It's never expected. And because of that, there was this fear that came on. There were people that were questioning, individual investors were questioning the markets. I maintain that these corrections happen. They happen a few times every year. It is healthy. Understand these corrections will happen, especially when we reach all-time highs so quickly. And I think you have to embrace the correction and use it as an opportunity. Use it as an opportunity to buy the investments that you always wanted to buy, but they were just too darn expensive. Now they are a lot cheaper. So to me, yeah, once you understand why the market went down and understand that it was because of fear that the U.S. economy is slowing down quicker than the Fed is basically saying, that is really what we saw earlier this week. And in my opinion, a lot, it was a lot overblown. I think it never should have fallen as much as it did. So I want to take a look at this idea. Is the Fed too slow to cut rates? And that is really what triggered or is triggering the fear in the markets, the fear in bond yields, the fear really everywhere that we see, whether it's the bond market, the stock market. Is the Fed too late to cut rates? Should they have already cut rates? And should they maybe even go 50 basis points in September? Well, my take on that very simply is this. I think they should only go a quarter point in September. If they were to go 50 or 75 basis points, I think the market would become very fearful very quickly. The market would think, and investors would think, perhaps the Fed is hiding something or knows something we don't know. Maybe things are a lot worse than they are, than what we see. And I think the market would sell off. I know that many believe that if they cut rates and cut rates quickly, that would spark the market and market would move significantly higher. I think if it did move higher, it would be quickly followed by a downturn in the market, again, based on fear that perhaps things are worse off than we believe. But let's look at what the Fed should be looking at. And we have a few charts here. Let's put up the first chart here. There we are. This is the, just get my glasses here. Job openings, right? I believe it's job openings. And we talk about JOLTS, which are the job openings, how many jobs are available. We talk about hires, who's hiring. You can clearly see here that the jobs data is definitely falling off, right? You can see that jobs data is falling from the top left to the bottom right. Not what you want to see, but maybe what the Fed would like to see when you're battling inflation. Let's take a look at another jobs. I think we have the jobs unemployment jobs chart here. There you go. That shows what I said off the top, 114,000 jobs created, 179,000 jobs created the month before. You could clearly see that there is a slowdown in jobs. So we have a slowdown in hiring, slowdown in job openings, a slowdown in jobs created. We don't have a chart on this, but I can tell you that manufacturing in the US right now, the last number we received was less than a number of 50. and 50 shows basically you're kind of flat. Anything above 50 shows expansion. Anything below 50 shows contraction. The last reading we received was below 48. So we are seeing a manufacturing or contraction in manufacturing in the US. So that again should be telling the Federal Reserve that things are slowing down. Let's go to our next chart here, which we have. And there you have it. That's retail sales. So you can clearly see that retail sales last month, barely above the flat line. It again, the month before that, obviously a little bit better. The month before that, you can see there was a decline in retail sales. So the consumer definitely appears to be tapped out, definitely appears to not be looking to spend as much, or at least look for as many bargains as they can. Just looking at here, they're continue to spend money, but definitely not at the pace and at the rate they were spending money before. Next chart here we have is on inflation. You can clearly see, and this is a great chart because you'll definitely see, and I have a copy of my chart here as well. You can clearly see where the Fed policy rate is, which is a flat rate. You can see it flattening out here towards the right side of the chart. You can see that core inflation, core CPI, 3.3%. Headline inflation or headline CPI is 3%. Important because we're going to get a CPI number pretty soon. Next week, I believe, we're going to get a CPI number. And you can also see that the PCE numbers, core and the headline number, in and around 2.5%. And that's the number that the Fed likes to look at a lot more than CPI. So, overall, you can say, tell that inflation is starting to come down as well. So has the Fed moved quick enough? Well, you have inflation coming down, CPI, PCE, you have retail sales falling, manufacturing in contraction, job openings coming down, hires coming down. You have job growth, jobs created falling as well. All these are major indicators. And if that's not enough, major banks are starting to say that individuals are not spending as much. Retail CEOs of retail companies saying people aren't spending as much. They're looking more selectively. They're looking at bargains. So is the Fed late to cut rates? Well, I leave that up to you to decide as the viewer. In my opinion, if I were the Fed, I would be cutting a 1/4 point in September and possibly, depending on the data, a 1/4 point, every meeting till the end of the year. There are 3 more meetings. I'd be cutting 3 more times. And to me, if they do that, and if they say that this is to accommodate a soft landing, this is not out of fear, but accommodating a soft landing, I think the market will like that. And I think we can see that soft landing that we've all anticipated for so long. So we'll have to see what the Fed does in September, but I believe a 1/4 basis point cut is pretty much a done deal. Bank of Canada being more dovish than the United States. And I guess that's obvious, right? The Bank of Canada has cut rates twice already, whereas the United States or the Federal Reserve has not cut at all. And there's talk now the Bank of Canada might cut a 3rd time in a row. There are starting to hear some rumblings out of some economists that the Bank of Canada is a lot more fearful of a recession in Canada. We know that GDP is just above the flat line. It's been that way for a little while now. And Bank of Canada is just simply more dovish. They looking to cut rates. They believe that restrictive interest rates, so interest rates too high to be too restrictive on the economy, is not warranted anymore. And they want to move to more of a neutral rate, which is where the Fed also wants to be at some point down the road. Our first chart here is one we've seen a number of times. This shows the inflation rate, Bank of Canada, bank rate, and the inflation rate. And you can see on the far right-hand side of our chart, you can see that the Bank of Canada rate has now started to fall, and the inflation rate has been falling as well, 4.5% in the Bank of Canada rate, and you're looking at around a 2.7% inflation rate right now. And so it's interesting because when we show this chart, it also shows the GDP, which is the bottom line there, if you all can see. And you can see right away that it is pretty much flatlining. You're not really getting much growth at this point in time, which should tell everybody that interest rates are definitely not accommodating. They're not even neutral. They are, I guess, in restrictive territory, still in restrictive territory. And the Bank of Canada is definitely working on bringing it down, I guess, gradually. But I guess one would say if they cut rates again in September, 3 rate cuts in a row is not really gradual. But having said that, they are definitely more dovish. The next, I guess, chart that we have here is on the bank, our different banks here in our country, our major banks. And you can see here, the main takeaway of this is that all the banks believe that we're going to be in and around 4% as a bank rate come the end of the year. So most banks are saying in the last 3 meetings, Bank of Canada is going to cut 2 out of the last 3 meetings. And that's really where all the banks fall. Now, some of them think they'll cut in September again, and then followed by one at the end of the year. Some might say September, and then November, and then maybe not at the end of the year. I guess it really doesn't matter. At the end of the day, the bank believes, or the major banks believe, that the bank rate will be at 4%. And then not only that, I also believe that the major banks and economists believe that the Bank of Canada will cut a couple of more times, and maybe the bank rate will end up somewhere around in that 3.5% area. Now, what will that do next year? I think it could be a red hot housing market come the springtime. If we were to see another 2 cuts this year, followed by maybe 1 or 2 cuts next year into the springtime, we could see a red hot housing market. And I know that's not what the Bank of Canada wants to see. So we'll have to wait to see what happens. Obviously, they're going to be the economic data dependent. So they're going to be data dependent, depending on what the Bank of Canada sees with inflation, CPI, retail sales, growth, GDP, the whole 9 yards. And we're going to get jobs out of Canada, our jobs data coming up on Friday, which again will be a big number for us to look at, to figure out whether the Bank of Canada cuts rates again, or will they hold until the next meeting. Now we come to the part of our show where I talk about 3 things that I think individual investors need to focus on before you make your investment decisions. And so for me, valuations, that's number 1. I think valuations, a lot of stocks, a lot of investments have been, I guess, revaluated, if that makes sense. The valuations have come down a lot in a lot of names, that trade on the TSX, a lot of names that trade in New York. And so you want to look at some of these companies that perhaps you wanted to look at in the past, but were just too expensive. So we want to consider valuations, sell strength and buy weakness. I find that a lot of people, when I tell them that that's what I like to do, sell into strength and buy weakness, they tend to look at me, stare at me with this glare, saying, what is this guy talking about? Why would he sell a good stock to buy one that's struggling? Well, we're going to talk a bit about that. And the third topic, or the third point I want individual investors to focus on, of course, like we have often up here, is economic data. And we've touched on the 2 pieces of data that I want to focus on, but we'll talk about them again. So let's get to valuations. And valuations on a number of stocks, as I've said, have come down tremendously over the past, let's call it, few weeks. The number 1 stock that I think for most of us, the biggest name that we all have come to know and love, NVIDIA. We have a chart on NVIDIA. Valuation on NVIDIA has come way down. And once well above 60, dropped to 40, then back up to 50 times earnings, now back to 40 times earnings, maybe even a little less now. NVIDIA, once upon a time, $140 stock at its peak. Now you're looking at 106, in and around that range. Not sure which trading today as yet, but when we took this chart, it was trading just above $100. So you can see, dropping 20-25%. There's been a re-rating of this stock. Looking at the valuation again and understanding that perhaps this is a name that if it fits your asset mix, if it fits your risk tolerance, if it fits your investment objectives, this perhaps could be a name that you wanna take a look at. And so valuation, as you know, is a big thing for me. Looking at the price versus the earnings versus the growth rate is pretty big. And as we know, Nvidia have not told us yet that that they're that we should be nervous of their valuation, nor should we be nervous about their growth rate. Everybody seems to keep spending money on artificial intelligence chips. The next chart we have here is Alphabet, or Google, as most of us know it. Again, this stock was much, much higher. As you can see here on the chart, this stock is much cheaper even than Nvidia, trading at 20 times, even under 20 times forward earnings for a company that's growing, for example, its cloud business, almost at 30% growth rate in the high 20% range. Obviously, it's artificial intelligence. It has search. It has everything. It even has driverless cars, self-driving cars with its Waymo division. This is a great company, a company that I think individual investors should definitely take a look at from a valuation perspective. Another name that I've talked about as well in the past, our next chart on Meta and, Meta Platforms, formerly known as Facebook. And this is a stock that's been a little bit all over the place, if I may say so myself. Stock traded at 550 at a high point, went down into the 450 range. Now it's come back just above 500. It's had definitely a great run. It had a great run on Tuesday, for example, after the market fell tremendously on the Monday. And Meta, another name like Google, trading in and around 20 times forward earnings. And they just blew out the numbers for their last quarterly report. It was a stock that did extremely well. And it has so many different things. We know over 3 billion users are active daily on their apps. And it's a stock that not only are they moving into the artificial intelligence area, going to be able to help those, but their ads, their digital ads, their the Facebook, their Instagram, WhatsApp, all the different apps that they have. It's just a fantastic company, and a name that, as I said, is definitely not too cheap, not too expensive. So valuation, that's the first thing I think individual investors should consider. Second thing, we want to sell strength and buy weakness. To me, that's very simple. And I guess the saying really should be buy low, sell high. It's kind of the same thing, but yet how many people actually do it? Buying low and selling high. When I tell people we want to sell the strength and buy the names that haven't been strong as yet or haven't gone up as yet, people look at me, why would you sell a good quality company to buy a weak company or a company that is not doing as well as yet? And I say, well, that's exactly why, because I think the weaker company or the company not performing well will perform well. And the company that is at the top of the heap, the number one name, might struggle because of competition and because it's just very hard to stay at the top. It's much more difficult staying at the top than it is getting to the top, as I've been told many times by my father many years ago. So to me, this is something that I think individual investors want to do. And I have a couple of stock charts here. First one, I believe, is on AMD, and a name that, this name, unbelievable. $227 stock at its peak. Today, in and around $130, $135 a share. Unbelievable fall. So again, perhaps you sell AMD when it was 180, 200, 210, and now maybe you want to buy weakness. You want to buy a name like AMD. And don't get me wrong, the name is not weak. They had unbelievable earnings. They took up their expectations for the rest of the year. They took up their sales numbers. They increased their sales numbers. We were talking, 4 billion roughly in profits and sales, and they went up to 4.5 billion. So this is a company that is firing on all cylinders, it seems like. Artificial intelligence, PCs, automobiles, and yet the stock has sold off. So a name that definitely I think you could sell some strength to buy some weakness. The second name here, I believe we have a stock chart of, is Lam Research, a fantastic company. Lam Research makes the equipment that helps make the chips. Chip equipment maker. Lam Research. This used to be a stock well over $1,000 a share, trading in and around or just around $800, just slightly below when this chart was taken. Again, a name that has sold off based on reasons that I think are not valid, at least for such a fall, and a name that I think you could look to buying the weakness. That's what we want to do. Another name here, Micron. Micron, they make, again, chips, but they make chips for specifically memory. Micron at the high, $157 a share. Today, in and around $90 a share. An unbelievable fall, 40% fall when we took this chart. And it's just a name that, yes, it's very cyclical. It has its ups and downs. It has its cycles. But a name that has been extremely strong, very important in the AI world. And, it's something that, yes, you want to trim when it is strong, but you want to buy when it is weak. A couple of names I wanted to get to here. I think the next one is Bank of America. And this is a stock that, perfect example of selling strength. I was a seller in and around $44 a share, $43 a share, but I quickly turned to a buyer, buying on the weakness, 37, buying on the dips, $37 a share. And this is a name that I think is a fantastic name to own. In my opinion, I think the best U.S. bank to own at this point in time, better than a Citigroup, better than even a JP Morgan, which I think is at the higher end of its range. Next chart, a chart we've shown many times here. This is a chart on Amazon. Amazon, another name, $200 a share not too long ago, a couple of weeks ago, $162. Again, selling strength. I was a seller of Amazon in and around 200. And again, not a full seller of Amazon, but I would trim some of the profits. You can never go wrong taking a profit. And I think that's what individual investors have to realize. You want to trim back some of those profits and then move those profits into names that aren't doing as well. So I was a seller of Amazon for a little while there, and now I'd be a buyer of Amazon at this point. So keep that idea in mind. You want to sell strength. You want to buy weakness. And right now, there seems to be a lot of weakness in a lot of areas. Third point I wanted to discuss is the economic data. What economic data should you be focused on? Well, first, CPI. CPI in the United States is coming out. I can believe it's next Wednesday. And we'll see. Will the CPI data validate this slowdown in the U.S. economy? CPI, measurement of inflation in the U.S. Will that validate the slowdown in the economy? And will that pretty much cement a rate cut of at least 25 basis points come September? The other economic data or data point I want to focus on here with a couple of charts. We're going to have one on CPI, but also Canadian jobs data. Canadian jobs numbers are coming out this Friday, and we've seen some weak numbers as of late. It's been actually flip-flopping a little bit. So let's see what the jobs data in Canada, and again, another number the Bank of Canada or the central bank will look at to see whether they cut interest rates again in September. So let's take a look at our first chart here on unemployment. And again, you could see that the unemployment rate in Canada moving up to 6.4%. Obviously coming off its lows, nowhere near what we've seen in the past, but definitely moving a lot higher. So that's, I think, starting to, I think the central bank or Bank of Canada is starting to take notice of the unemployment rate. And again, keep in mind, central banks have two mandates: full employment and stable prices. Stable prices is what they've been trying to achieve, but now we're starting to see that the unemployment rate is ticking higher. And so perhaps central banks need to now work on getting that under control. Second chart we have here, which is, there we go. We can pull it up here. Second chart. There we go. US CPI. And again, you could see how the CPI rate, 3.3%, I believe it is, on the core, 3% on the headline number. To me, that just shows that things are starting to come down, but not fast enough. We see PCE, another inflation point for the Fed that they tend to look at, already showing about a 2.5% inflation rate. So what will CPI tell us next Wednesday? will signal that things are coming down. In my opinion, as long as it doesn't show a big slowdown, too much of a slowdown, like falling off a cliff, I think that a continued slowdown would be a good thing. And again, would cement a quarter basis point cut for the Fed. So these are the three things, in my opinion, individual investors need to focus on in the next couple of weeks before you make your investment decisions. Some economic data, valuations, and that old adage, right? You want to buy low and sell high. So the Mag 7 versus the other 493 companies on the S&P 500. We talk about the Mag 7 all the time, and that's because at one point they made up a third of the growth of the S&P. They made up, in terms of market cap, something like 20% of the S&P 500. These are the largest companies in the world today. Some of them over $3 trillion. Microsoft, Apple, and NVIDIA. They may have pulled back a little bit now from that $3 trillion mark, but make no mistake, these are the biggest companies. And then you have Alphabet, $2 trillion. And, these are huge companies, Meta, $1 trillion market cap. So should you be buying these names now that they have fallen, buy on the dips, or should you be looking at the other 493 companies that trade on the S&P 500? And I guess the easy answer for me, for all of you today, is I think you want to do both. I think you want to have a diversified portfolio. I think you want to own a couple of the Mag 7 names, but you also want to own names in other sectors, because I think when technology is not doing well, or the big cap tech names aren't doing well, you can now, hopefully, the other 493 names can pick up the slack for these 7. First chart we have here, which shows exactly, I think it's actually one of the best charts that we have. It shows that the Mag 7, how they're trading. You can see here on a PE basis how they're trading. Actually, this is Mag 7 versus the market. The PE will be the next one, but you can see here how the Mag 7 is trading versus the rest of the market, and you can see how much the Mag 7 has come down versus the market. It's led the market to the upside and has led the market to the downside. Next chart here is the one I was referring to, the PE of the 7 stocks that make up the Mag 7. You can see Tesla, which probably hasn't had the best performance in the last little while. They are at the top there, so their PE ratio is still pretty high, but you could see a whole bunch of the stocks in the middle there with roughly the same PEs, Amazon being one of them, for example, Apple, another example. And then you see a couple of names below that. You could see Google and Meta. So for me, as I've said on our show many times, out of the Mag 7 or the big the big tech names, I think you can own, take a look at a Google or a Meta. To me, these names make a lot of sense. They're growing earnings by quite a bit, high percentage, and yet their earnings, even though their earnings are going up, their price isn't matching. And so to me, these names now represent pretty good value. You can, take a look at some of the individual names. Let's take a look at some of the charts. I think we have a chart on Tesla first. Let's take a look at a Tesla chart. You can see there, Tesla coming down. A lot of people asking me about Tesla. Do I think it's a good buy at these rates or at this level? And to me, I would say no. And the reason being is for the chart we saw before this, that it still is quite expensive. Next chart we have here is the one on Apple. And again, Apple growing their earnings, probably high single digits, 8-10%, yet their stock is trading at over a 30 multiple. So would I be a buyer of Apple? Probably not. I think it's a little too expensive. I think a lot of people would agree it's too expensive. Yet the question always is that premium you're paying for buying the shares, is that justified based on, based on the company, based on its products, and how many people use their products? The next chart we have here, coming away from the Mag 7. So those are two names in the Mag 7 that I wouldn't be a buyer of. I discussed already some of the names that I would be a buyer of, like Google, like a Meta. But what would I consider as part of the other 493? Well, first stock we have here is a name in the pharma space. We have Pfizer. Now, Pfizer for a little while there was paying like a 6.5% dividend. Well, finally, the stock has picked up. Well, actually was over $31 a share only just a few days ago prior to the recent pullback and scare in the markets. Now it's trading just under $30 a share, as you can see when this chart was taken. But a name that I think has tremendous potential, getting into the weight loss area, in oncology, still does some COVID vaccine. But now you'd be a buyer of Pfizer based on its cancer drugs, its weight loss drugs. They're actually trying to come up with a pill to that people could take to bring down their weight versus the injections that they have now. So Pfizer trading pretty cheaply, a name that I would consider. Next chart is at JP Morgan. JP Morgan, as I said, I like Bank of America a little bit better, but JP Morgan has had a bit of a pullback now. It's another name that I think if you owned as part of the other 493, it'd be a pretty good balance, pretty good diversification to the tech names. And it's a name that I've owned for individual investors for quite some time. And to me, it's a name that I think you can get behind, largest bank in North America, really, and a name that I think that still has room to run, especially now that it has declined over the past, well, let's call it last maybe week or two. The next name we have a chart of United Rentals. We can pull that chart up. Now, United Rentals is interesting. Not many people know about United Rentals. It is a name that basically they're in the heavy machinery business, like a Caterpillar, except they rent their machinery rather than Caterpillar who sells. I believe Caterpillar also rents machinery as well. Caterpillar is all over the world. Caterpillar actually produced some pretty good earnings just in the last few days. Stock went up tremendously, I believe, just yesterday on Tuesday. And Caterpillar is a name that I think you could take a look at. But United Rentals is trading actually a little bit cheaper than Caterpillar. And it's a name that's had a fantastic run, making new highs from time to time. Its business is primarily in North America. And as you can see here, has pulled back recently. Although last we took this, the snapshot of the stock was up about 3% on the day we took it just a few days ago. I think actually yesterday. And overall, it's been a name that I think you can take a look at for a good diversified portfolio. So Mag 7 versus the other 493. Well, I think you need to own both. I think you need to own some of the Mag 7 that makes sense from a valuation standpoint. A lot of them have come down in value. Maybe even look at a Microsoft. Still trading at high multiples, but growing very quickly. Meta, Google, and now maybe NVIDIA. NVIDIA has come down 20-25% from its highs. Still not a cheap stock, but a lot cheaper than it used to be. So you want to buy some of the Mag 7, some of the big cap tech names, especially if you're looking for growth. And then you want to fill out a portfolio using the other 493 names of the S&P 500 to have a nice diversified portfolio. Quick hits. This is a part of the show that we just added a few shows ago. And as some of you that watch the show know, these are three things that have appeared in the news recently. And I kind of wanted to make a bit of a comment on all three. First one, Toronto condo market in a rough patch right now. We're seeing sales that are down. There's a reason for that. We'll touch on it pretty briefly. Could NVIDIA, could their AI chip be delayed? We know that the rumor out there is that NVIDIA, their most recent creation, their Blackwell chip for NVIDIA, was supposed to come out in the fourth quarter of this year. There's now been reports that it's going to be delayed. There was a bit of a flaw in the product, and they've had to delay the launch to the first quarter of next year. What does that mean for NVIDIA? Well, I can tell you, if it proves to be true, NVIDIA stock will probably pull back. And In fact, it probably has already pulled back based on that rumor. The last one, Warren Buffett sells half of his Apple holdings. Interesting statistic about that is even though they've sold off a lot of their Apple holdings, Apple still remains one of its largest holdings at Berkshire Hathaway, which is Warren Buffett's stock or company. So I guess the headline's a little misleading. So let's talk very quickly about the condo market having a bit of a rough patch in our country. We have a chart we can pull up on the condo market, which clearly shows that, yeah, condo sales are down. They're down by quite a bit. And I guess you could attribute that to a couple of things. These are new condo sales, not older ones, but new condo sales down by quite a bit. 70% of condo sales are actually done or purchased by investors. So these aren't people that are moving in. These are actually people buying it as an investment. And with interest rates still high in Canada, with costs rising to carry that condo purchase, and it just doesn't make sense right now to own or purchase a new condo. They're just too darn expensive to buy in the city of Toronto. And the builders don't want to cut their pricing because to build the condo, the costs of building are still very, very high. So we're seeing condo sales fall. And if I'm not mistaken, it's they've fallen by the most we've seen since the 90s. So for many that I talk to, they say, well, Toronto's becoming a place of condominiums. Well, that may be true, but it looks like the condo sales are definitely slowing down. And, it's hard to say what's going to cause condo sales to spike back up. Perhaps it'll be lower interest rates. That probably will get things moving again. And so maybe the condo market will see a bit of a decline, but hopefully will perk back up in the spring of next year. The next news item, I guess, quick hit, as we call it, that I wanted to discuss is NVIDIA. And that whole idea that their chip has been delayed. I've talked to a few people and no one seems to know the real truth. Right now, it's just a report. NVIDIA hasn't come out and said anything as of yet. But overall, if NVIDIA were to not produce or at least not sell their new chip in the fourth quarter of this year, obviously that would be could be a blow to its sales. It would also hamper a lot of the companies that use NVIDIA chips, like Meta, like Google, like Amazon, like Microsoft, and the like. So this is and like Apple as well. So all the big tech names use NVIDIA. All of their spending, their spending that they plan on for the next year is going to, and a lot of it's going to NVIDIA, some of it to AMD, of course, for these AI chips. So if that chip is delayed to the new year, that would be an issue. And we actually have a chart on NVIDIA once again, and this is a short-term chart, and you can see how much NVIDIA has dipped in the last little while. I think a lot of it based on what's happened in the general market, but also some of it to do with perhaps a delay in their chips. The last news topic I wanted to touch on briefly is this whole idea that Warren Buffett has sold out of Apple stock. Now, as I said, keep in mind, they still own half their position, which is a very large position, still one of the largest in their portfolio. So anyone that was selling because Warren Buffett sold, I think that was a mistake. If that's the reason why you're selling. If you're selling Apple or trimming some of the profits because its valuation is a little bit stretched, then that makes more sense to me. I would say to hold Apple. I'm probably not a buyer of Apple at these levels. I'm not a seller of the whole position, but I would be a hold and maybe trim some of the profits. So to me, those are the three, I guess, news items or ideas that I've been seeing a lot of in the news in the last little while. And I wanted to provide a comment to all of you on each of them. Now we come to the part of the show that I always like best, right? Try to take as many questions as I can. And as always, our show runs a little longer than I anticipate. I tend to talk, get into things a little bit in greater detail. And so hopefully all of you enjoy that. So we have time for one question today, and I'll put on my glasses for this. How do you measure success? This came from, I guess, an investor during our show. How do you measure success for a client? What should I expect from my advisor? I think that's a great question. And how do you measure success? Well, I guess you measure success based on if you achieve your investment objectives. How do I, as an investment advisor, measure, or basically decide if we're successful, if that investor or client of mine is successful? It's based on whether I help them achieve their investment objectives. So to me, it's all about that. If your objectives are to produce an income, to supplement your income, you need your investments to produce an income for you to live off of. And that's what it does, but it never goes up and it never goes down. That is, the portfolio never goes up and never goes down, but just continues to maintain or pay you out that dividend income, for example, then that is success. If you want your portfolio to grow so that you could have a good retirement and we reach our targets that we set out for ourselves, a target rate, a growth rate, 7, 8, 10%, if we can do that on average over a 5-10-year period, then that's success. So it just depends on the investor. What every investor should look at: what is successful for them? What are their goals? What do they want their investments to do for them? And if they can achieve that, that to me is success. That to me is what we want to do. And that is what I would say, all of you. And I know for some, they're going to say, well, my portfolio didn't grow. But yeah, but you wanted an income generating portfolio. So if you're building an income generating portfolio, you're probably not going to get a lot of growth. If you're building a growth portfolio, you may not be getting a lot of income generation. So you really have to look at what it is your investment objectives are and what you're trying to accomplish when you, I guess, create or establish your portfolio from scratch, which is what we do every day at the Allan Small Financial Group. So with that, I want to say thank you to all of you for joining me this week. It's been a pleasure as always. And I know a lot of you have been nervous and not understanding what's going on out there with portfolios and the markets. Hopefully we've shed some light, given you some food for thought, some ideas, some rationale, some reasons behind some of the things. And if you take away a few of those into your investment and your investment selection, I think that would be fantastic from all of us here. So again, I want to say thank you to all of you, and I look forward to seeing you all again on August the 21st at 12 noon, so same time. And until then, happy investing.